strongly so to the upside. There's a little slight dip, but we still have upward momentum here in that predicted moving average, and so you might want to just keep your stop below a previous low and just kind of use the traditional technical analysis trading stop type of thing. You just keep it up here, whoops, and then keep it after this occurs, keep it here, and ride the market all the way, and just keep your stops, well below the previous low, and then ride it up as far as you possibly can until it gets to a point, of course, where at some point all good trends are going to end. That just kind of gives you an outline of the strategy to get into the market in this particular case in the U.S. dollar index. You need to then determine what are we going to do as the market moves situation in this area right here when we go through right in here where we had some possibilities for trading, chopping some small losses, not as good a move as we had at the beginning, but if you're following a strategy or a system, you don't know exactly when those are going to occur and when the best bet's going to be. But, it's important to have risk under control every time you start a position, to move a stop, keep a stop where you won't be taking that big risk as the market moves up. Now let's look at, kind of get caught up here on the current times and where we would be with the market as it has been recently. And we'll look here at, let's start with June the 9th, let's say, which is where we had the situation come right in here. First of all, we need to point out that we had if you remember, we were talking about this doji top. Okay, that's turn yet in the various other indicators, but we have had at least that alert that something may be going on, and that we always need to be aware of what is going on. So we're going to keep a stop below the predicted next day low. On June the 9th, that predicted low was 88.02, and so that would put our stop situation at 87.52. Again, I'm not going to be real precise probably about this, but seeing that, it's going to come in right in there, 87.52. You need to have this candle for June 9th in place before you can really do that. So on June 10th, 87.52, you would be stopped out. Now, the other thing, if you were in a long position, I should say, because that would have caused you to be out of a position, it would have gotten you a small loss, but that's the way sometimes trading works. You can't count on a gain on every position. You're going to have your losses as well. As now, when you look at the way the candles have occurred here, we talked about this candle right here. We could potentially get two different signals on the same day. The first on June 10th, as I mentioned, is one that got you out, but when you look at this predicted low, you could say, okay, the predicted low on this particular day was 88.02, and so at 87.52, not only would you be out, but you then, could say, okay, I am going to use this as my target to get short. So that could be a point at which you enter a short position. After this, again, you have to have this candle in place before you can make all these decisions, but you can see what's going on here. We have the turn, predicted differences, have now pointed down. The neural index is at 0. We have the predicted medium-term moving average starts to turn down. It makes its initial move. So all these things are coming together to say the situation has changed. We have a scenario, but if we are shorter-term traders, there are ways in a counter trend to capitalize on a turn down that you can ride that and play the market down as well as up. So in this particular case, we would say that, okay, we're going to be short, and we're going to have our stop, because we want to make sure again that we have our stop, that we're going to be in the market and not have to worry about that huge loss. But we're going to, on June 17th, I should point out our stop situation on June 17th, which is today, said that it should be the predicted high was 86.77 for June 17th, and so that means our stop would be at 87.27, which would be somewhere right in there. So if the market did move back above that, we would be stopped out of our short position. Now currently, and as of the action that I was monitoring a little while before, it is still have at least the short-term trend to the downside, and so that if it does turn, you want to be out when it does come back up to 87.27, which I don't believe had occurred yet today. You're stopped there. It's not going to be maybe the biggest move of all time, but it assures you that we'll have a small profit if you have an Oreo and you don't have a situation come about where you have some extreme movement, such as we had in the stock market. When you think about what happened to the stock market going back to May 6th with a flash crash, when not a lot you could do about any of that kind of stuff, but sometimes those things also will happen. Very hard to protect yourself against those, but you need to be aware that they do happen, but you need to protect yourself against those things for which you can protect yourself. Now, just quickly, we're going to take a look at the euro, which is kind of the opposite type of an effect. We're not going to spend as much time on it because most of the dollar, particularly in the euro, it has a larger value. So we would use, remember what we said before, we were using our guideline was going to be 50 points. Well, in this case, for the euro, we are going to use a predicted high or predicted low plus or minus 100 points, because we're talking about a market that has a little higher type of a number, which it trades, then at 123 generally, that area, versus what we were talking about, 80 something in the dollar. So we're going to use 100 points above the high. We also have in the futures contract case a larger account. We have 125,000 account. So we will probably, because of the larger account, if we want to change, if we have our 5% of our account that we're going to risk in our $20,000 account, that's $1,000 that we were willing to risk. It's going to be 80 ticks that we would be willing to risk on a trade that we get in. We don't want to lose more than that on the trade because we don't want to violate our risk limit. Now, just briefly to catch you up to where the situation is right now on June the 9th. Again, we had a situation here where the momentum of the predicted moving average is slowing down a little bit. As you can see, it starts to turn. We have euro index that has moved up to 1. We have the predicted differences have started